You've seen it happen. A stock wobbles, a market dips maybe 10%, and suddenly an account that looked solid is vaporized, wiped out. You hear the term margin call thrown around like some technicality, but it's not a technicality. It's the market's final, fastest verdict. Because leverage doesn't make you smarter or more right. It just makes the market's judgment arrive with brutal mathematical speed. And understanding that math is the first step to seeing how markets really work under the hood. Let's strip away the brochure speak and look at the engine. Here's the core of it, the simple but deceptive math. Imagine you want to own $10,000 of a stock. With 50% margin, you only need to put up $5,000 of your own cash. Your broker lends you the other $5,000. As long as the stock price is rising, this feels like genius. A 10% gain in the stock to $11,000 is a $1,000 profit. But since you only put up $5,000, that's a 20% return on your capital. You've doubled the market's move. But the amplifier works both ways. The stock drops 10%. Your position is now worth $9,000. That $1,000 loss comes directly out of your $5,000 in equity. Your equity is now $4,000. You lost 20% of your capital on a 10% market move. The loan from the broker is a fixed number. It doesn't shrink when the stock falls. All the pain is concentrated on your slice of the pie. This is leverage acting not as a tool, but as a fast-forward button on your losses. Brokers sell this as buying power, a friendly term for a loan. Let's translate the marketing. The health of your account is governed by a simple equation. Your equity equals the market value of your securities minus the amount of your loan. This equity is your cushion, your buffer against the market swings. And your account lives between two critical thresholds, the initial margin and the maintenance margin. These aren't suggestions, they're hard limits. The initial margin is your ticket to the game, the down payment you must post to open a leveraged position. In the United States, Federal Reserve Regulation T has set this at 50% for most stocks since 1974. A line drawn in the sand after decades of volatility. The second, more dangerous fence is the maintenance margin. This is the minimum percentage of equity you must maintain in your account at all times. The regulatory floor is 25%, but most brokers set their house rule higher, often at 30 or even 40%. If your equity drops below this line, the clock starts ticking. Let's watch a margin call happen in slow motion. You decide to buy $20,000 of a broad market index fund. On 50% margin, you put up $10,000 in cash and you borrow $10,000 from your broker. Your initial equity is 50%. You're well clear of the maintenance fence, which we'll say is 30% for this broker. The market feels solid. Then, a rough week. The market dips 10%. Your position falls to $18,000. The $10,000 loan is still there, so the $2,000 loss comes entirely from your equity. Your equity is now $8,000. Let's check the math. 8,000 divided by 18,000 is about 44%. You feel the sting of a 20% loss on your capital, but you're still safely above the 30% maintenance line. No calls yet, just anxiety. The slide continues. Another 20% drop from there. Your position, once worth $18,000, is now worth $14,400. The loan is still $10,000. Your equity has shrunk to just $4,400. Your new equity ratio is just over 30%. You are now hovering right on the broker's maintenance line. The warning lights are blinking. Every small tick down feels like a punch to the gut. You're one bad day away from a phone call you don't want to get. Then it comes. One more down leg, another 20% fall. The market value of your position is now just $11,520. Your equity is a mere $1,520. The ratio has cratered to 13%, far below the 30% minimum. The system flags your account. You get the message. Deposit more cash or securities immediately, or we will start liquidating your position. This isn't a negotiation. It's a deadline. Your broker sells your holdings near the bottom to pay back their loan, locking in your catastrophic losses. It's not personal, it's just arithmetic. This same math, just with more zeros, took down some of the smartest people in the room. In the mid-90s, long-term capital management was the hedge fund equivalent of a supergroup, packed with PhDs and 2 Nobel Prize winners. They ran complex convergence trades, betting that tiny, temporary mispricings between related securities would eventually correct. And for years, they were right, generating incredible returns. The catch? To make those tiny spreads meaningful, they used enormous leverage. At its peak, the fund had borrowed over $30 for every $1 of its own capital. Their models said a global panic was a near impossibility. Then, in August 1998, Russia defaulted on its debt. The impossible happened. Instead of converging, the spreads they were betting on blew wide open as investors fled to safety. Their losses were staggering. Their lenders, the prime brokers, got nervous and started raising the collateral requirements, the haircuts. Suddenly, LTCM faced massive, daily margin calls. Their trades might have been right in the long run, but they were out of time and out of money in the short run. The fund was so interconnected with the global banking system that the New York Federal Reserve had to orchestrate a $3.6 billion private bailout to prevent a systemic meltdown. Fast forward to 2021. The actor is different, but the plot is the same. Archegos Capital Management, a private family office, built up gigantic, concentrated positions in a handful of stocks. But it didn't do this by buying shares on margin directly. It used a financial instrument called a total return swap. This allowed Archegos to get all the economic exposure of owning the stock without the stock ever appearing on its books. And it did this with multiple banks simultaneously. Each bank saw only its own piece of the puzzle, unaware that Archegos was building a 5 to 8 times leveraged tower of risk across all of them. When one of its key holdings, ViacomCBS, announced a new stock offering, the price dipped. That was the first domino. The dip triggered margin calls from Archegos' lenders, but because the leverage was so high, the firm couldn't meet them. One bank got spooked and started selling off its chunk of the Archegos portfolio to protect itself. This selling pushed the stock prices down further, triggering margin calls at the other banks. It became a frantic race to the exit, a classic prisoner's dilemma. In a matter of days, tens of billions in market value were erased, and banks like Credit Suisse and Nomura were left holding over $10 billion in combined losses. A private bet became a public spectacle of destruction, all because of hidden leverage. In the world of futures, the clock ticks even faster. Futures margin isn't a down payment on an asset, it's a performance bond, a good faith deposit to ensure you'll make good on your contract. This initial margin is a small fraction of the contract's total value, often just 5 to 15%. This creates massive leverage. And here's the kicker. Your account is marked to market every single day. At the end of each session, profits are added to your account and losses are taken out. A 1 or 2% adverse move in the underlying asset can be enough to wipe out your initial margin and trigger a same-day call for more funds. You can be right about the long-term direction and still be forced out of your trade today. Leverage is even more punishing for those betting on a decline. When you short a stock, you borrow shares and sell them, hoping to buy them back later at a lower price. This is inherently a margined position, but unlike a long position where your loss is capped if the stock goes to zero, a short seller's potential loss is theoretically infinite if the stock keeps rising. As the stock price goes up, your losses mount, and your required maintenance margin also increases. It's like being on a treadmill that speeds up and inclines steeper the longer you run. This is the mechanical fuel for a short squeeze. Forced buying from margin calls creates more buying pressure, driving the price even higher in a vicious feedback loop. From the roaring 20s to the dot-com bubble to the 2008 crisis, the pattern is the same. It's the leverage cycle. During periods of low volatility and rising prices, lending standards relax. Brokers' loans in the late 1920s doubled in just 2 years, fueling the mania. Lenders and borrowers both become complacent. Leverage builds quietly throughout the system. But this very process creates fragility. When the turn inevitably comes, the cycle violently reverses. Losses reduce equity, triggering margin calls, which forces selling, which drives prices lower, creating more losses. It's a self-reinforcing downward spiral. Leverage is pro-cyclical. It amplifies the good times and makes the bad times catastrophic. Regulators, having seen this movie too many times, have put up guardrails. That 50% initial margin in Regulation T, stable since 1974, was designed to be a permanent circuit breaker on runaway speculation. After the dot-com bust, where retail traders churned accounts into dust, we got the pattern day trader rule in 2001. It requires anyone making 4 or more day trades in 5 days to maintain at least $25,000 in equity. These rules aren't just bureaucracy. They are scars from past crashes, designed to limit the fuel for the next fire. And this mechanism isn't just for individual traders. It's the deep plumbing of the entire market. During the GameStop mania in 2021, the issue wasn't just retail margin calls. It was a step higher up the chain. As volatility exploded, the central clearinghouses that sit between brokers demanded vastly more collateral from the brokers themselves, like Robinhood. To reduce their own risk and meet these massive deposit requirements, the brokers had to restrict buying in those specific stocks. The plumbing of collateral calls forced their hand, overriding the desires of millions of their customers. It was a stark reminder. When panic hits, the rules are set by those who manage the risk, not those who place the bets. So here is the one implication that matters. In a leveraged market, there are 2 conversations happening at once. There's the public debate about a company's future, its earnings, its story. That's the one everyone follows. But there's a second, private conversation happening between borrowers and lenders about collateral and funding. In the long run, the story might matter. But minute to minute, day to day, the conversation about collateral is the only one that counts. The greatest risk isn't being wrong about your idea. It's running out of time and money before the market agrees with you. This isn't about chasing hot tips. This is understanding the machine. If this clicked for you, subscribe and drop a like. We don't do predictions or stock tips here. We just take the machine apart to see how it works. There's more on bubbles, crashes, short squeezes, and the mechanics that make prices jump. Stick around. See you in the next one.